Imagine this. You're a genius. IQ off the charts, degrees from top universities, a mind sharper than a Wall Street trader's suit. But your bank account? It's bleeding red. Why? Because intelligence doesn't equal financial success. In fact, it often leads straight to ruin. Stick around, because in the next 10 minutes, I'm revealing the 7 shocking reasons why smart people lose money and how you can avoid their fatal mistakes. This could save your fortune. Welcome to True Grind, where we decode the secrets of wealth without the fluff. Today, we're exposing a paradox. Some of the smartest people alive, doctors, engineers, even CEOs, still end up broke. And it's not because they lack intelligence. The real enemy is behavioral traps. Lifestyle inflation, emotional spending, and overconfidence quietly destroy wealth no matter how high the income. In this video, we'll break down the science behind these mistakes and give you practical fixes you can apply immediately. If you want to build wealth the smart way, not just earn money, but keep it, let's get into it. Reason number 1, overconfidence. Smart people often believe they're untouchable. They assume their intelligence gives them a special edge in the market, like they can predict the future just by thinking harder. But behavioral finance studies tell a brutal truth. Overconfident investors trade 67% more and end up earning 20% less. Take John, a brilliant physicist. Numbers were his comfort zone. He poured his life savings into what he called a guaranteed stock. No backup plan, no exit strategy. The stock crashed hard, not because he wasn't smart, but because he ignored the data. The fix is simple, but not easy. Diversify your investments. Use stop-loss orders. Assume you can be wrong, because the market doesn't care about your IQ or your PhD. Reason 2, emotions often override logic. Even the smartest investors can panic sell during market crashes or get greedy and buy at the top. Nobel Prize winner Daniel Kahneman showed that our brains are wired for loss aversion. We feel losses twice as strongly as gains. Take Sarah, for example, a brilliant lawyer who sold her investments during the 2008 crash. She missed the market recovery and ended up losing millions. So, what's the solution? Stick to a rules-based system, automate your investments, set clear guidelines, and tune out the noise. Remember, emotions are the silent killer of wealth, and staying disciplined is what separates long-term success from costly mistakes. Reason 3, no diversification. Smart people love the next big thing. They find one brilliant idea, one sure bet, and go all in because confidence feels smarter than caution. But history is brutal to one-basket thinkers. Warren Buffett warned us, diversification is protection against ignorance. And ignorance isn't stupidity, it's uncertainty. Take Enron. Executives with Ivy League degrees tied their salaries, bonuses, and retirement to company stock. When Enron collapsed, their careers and wealth vanished overnight. The fix is boring, but powerful. Spread risk across assets, stocks, bonds, real estate. Use low-cost index funds for broad exposure. Because one egg in one basket? That's not confidence. That's an omelet waiting to happen. Reason 4, following the herd. Intelligent people love to believe they're independent thinkers, but markets have a way of humbling everyone. Even top minds end up chasing trends, whether it's crypto hype, meme stocks, or the latest can't-lose investment. Behavioral economist Robert Shiller calls this irrational exuberance, when excitement replaces logic. Look at the GameStop frenzy. Highly educated traders piled in, driven by FOMO instead of fundamentals. A few made headlines, but most bought late and crashed hard. The fix? Think for yourself. Do independent research. Question popular narratives. Real wealth isn't built by following noise. It's built by discipline. Remember the rule that separates amateurs from pros. Be fearful when others are greedy, and greedy when others are fearful. Reason 5. Complexity bias. Smart people love complexity. The more advanced something sounds, the smarter it feels. So instead of simple investments, they chase exotic derivatives, high-frequency algorithms, and genius-level strategies. But here's the irony. Complexity doesn't equal returns. Study after study shows that simple index funds outperform nearly 90% of active managers over time. No secret formulas, no fancy math, just consistency. Look at 2008. Hedge funds run by Ivy League quants built foolproof models packed with assumptions. When the market behaved differently, those models collapsed, and billions vanished overnight. The lesson? Simple beats smart. Focus on fundamentals, low costs, diversification, and long-term discipline. Because in investing, complexity isn't power, it's friction, and friction kills execution. Reason 6. Ignoring opportunity costs. Smart people hate admitting they're wrong. So instead of cutting losses, they cling to failing investments because of sunk costs, time, money, ego already spent. But here's the trap: opportunity cost. It's not just about what you're losing, it's about what you're missing by staying stuck. Imagine a tech executive holding on to a dying startup stock for years while FANG stocks quietly 10 times in the background. The real loss wasn't the bad stock. It was the missed opportunity. Every dollar has a job. If it's trapped in a loser, it can't work somewhere better. The fix is simple but brutal. Ask one question. If I had cash today, would I still buy this? If the answer is no, walk away. Cut losses early. Capital is replaceable. Time isn't. Your future self will thank you. Reason 7. Not learning from mistakes. Smart people don't always fail because they lack intelligence. They fail because they rationalize losses instead of studying them. A bad trade becomes bad luck. A missed signal becomes the market was rigged. But growth doesn't happen there. The most successful traders do the opposite. They document everything. They journal their trades, their emotions, their assumptions, and their outcomes. Research shows that this simple habit can boost returns by up to 15% just by forcing honest self-review. Billionaire investor Ray Dalio calls this radical transparency, being brutally honest about what went wrong and why. Every loss carries a lesson, but only if you're willing to look. Ignore reflection, and you don't just lose money, you repeat history. There you have it. The 7 reasons smart people lose money, not because they aren't intelligent, but because they're human. Overconfidence makes us believe we can't be wrong. Emotions push us to buy high and sell low. A lack of diversification turns one bad decision into a major loss. Herd mentality convinces us that following the crowd is safe. Complex strategies hide risk instead of reducing it. Opportunity costs slowly drain wealth in the background. And failing to learn from mistakes guarantees we repeat them. But here's the good news. You're smarter now. The fixes are simple and proven. Diversify your investments. Automate decisions so emotions stay out of it. Simplify your strategy so you can stay consistent. And regularly reflect on what's working. Because wealth isn't about IQ, it's about discipline and behavior. If this hit home, like, subscribe, and comment below. What's your biggest money mistake? Turn knowledge into action. Your bank account depends on it. See you on the next one.